Welcome to QuanX News. I'm Prasann Koli with your market update. Indian equity markets witnessed a sharp sell-off today, with the Sensex crashing nearly 200 points and the Nifty slipping below the crucial 23,900 mark. After a promising start, both benchmarks reversed course dramatically, weighed down by intensifying geopolitical tensions between India and Pakistan, weak Q4 earnings, and widespread profit booking across sectors. The Sensex, which had initially opened strong by gaining over 300 points to cross 80,000 in early trade, ended the day deep in the red, down 119.5 points or 1%, closing at 605.81. Meanwhile, the Nifty tumbled 30.98 points or 1.64% to settle at 2347.85. In just a few hours, nearly 7.5 lakh crore of investor wealth was wiped out, highlighting the sheer magnitude of the sell-off. Let's talk about the major triggers behind today's decline. The biggest driver was geopolitical risk. Tensions along the line of control escalated following Thursday night's reported retaliatory strikes by the Indian Army in response to Pakistani firing. This comes just days after a terror attack in Pahalgam, Kashmir, that killed 26 people. Mostly tourists, the government is reportedly considering suspending the Indus Water Treaty and downgrading diplomatic ties with Pakistan, adding to investor nervousness. Beyond geopolitics, the markets also reacted to underwhelming Q4 earnings. While expectations were high, the early trend is not reassuring. A money control analysis of 11 companies, excluding energy, BFSI, and insurance, reveals that operating profit growth slowed to just 6% year on year. This marks the seventh straight quarter of single digit growth and the weakest pace in the last 5 quarters. The numbers signal that post pandemic demand recovery is flattening and margin pressures are still very much present. Profit booking was another key factor. After a 7 day rally that took benchmarks to record highs, investors likely saw this as an opportunity to book gains. On Thursday, the markets had already shown signs of fatigue, and today's geopolitical developments triggered the perfect storm for a deeper correction. Sectorally, the pain was widespread. The Nifty Bank Index lost nearly 1.6%. Axis Bank was the biggest laggard, falling over 35% after posting a slight dip in Q4 net profit to 7,030 crore from 730 crore a year ago. Most major bank stocks, including ICICI Bank and SBI, ended lower, with only IndusInd Bank managing to stay marginally in the green. Other major losers included Adani Enterprises, Adani Ports, Jio Financial Services, and Trent, all seeing declines of up to 6% during the session. Despite some optimism in the global markets and continued fighter inflows, domestic sentiment clearly took a hit. On the other hand, shares of Siemens Limited surged nearly 7% after the NCLT cleared its demerger plan, allowing Siemens in India to operate as a standalone entity starting April 2025. This restructuring move was welcomed by investors, bringing some positive momentum to an otherwise gloomy trading day. Traders are now closely watching the 23,600 support level on the Nifty. A break below this could open doors for further downside towards 23,300 in the near term. Resistance is now seen at 23,900 to 24,000, and only a strong recovery above that range can restore short-term bullish momentum. Looking ahead, investors will be keeping a close eye on the evolving Indo-Pak situation, upcoming RBI policy commentary, and earnings from heavyweight companies. The market's ability to hold key support levels amidst heightened volatility will determine the trend going into May. That's it for today on QuanX News. Thanks to our sponsor, Quintox Solutions. Stay informed and join me, Prasann Koli, next time for more insightful market updates.